I don't know if you were surprised is the right word, but certainly the China relationship has now become a major market mover just in the last week. And we were joking the other day on the show that it almost feels comfortable, familiar to be talking about U.S.-China relations as kind of the marginal driver of stock prices on a day-to-day basis.
Yeah, I mean, I suspect it's nice to focus attention away any chance we can from the coronavirus, although I suspect that this market is going to continue to be trading on, how we're doing in getting cases to plateau or compress in certain parts of the country and what reopening is looking like in certain parts of the country that are going ahead of it. Look, the reality of what's going on with China is we've all been left as strategists, economists, business leaders to contemplate what the rules of the game are going to be. And so, the idea around, these types of conflicts is ultimately they'll create less efficient outcomes. And so, but we can navigate that so long as a period of uncertainty doesn't persist. I mean, that's really what 2018 was just a period of uncertainty that led markets to go lower. And look, if whether it's, a next step on a trade war or, elimination of a special status for Hong Kong, I mean, ultimately, businesses need to know what the rules are and figure out how they can navigate within those rules.
All right, so let's go back then to the uncertainty just here in the U.S. that we've dealt with in the last couple of months. The S&P right now trading back above 3,000. We've seen a significant retracement of those losses that we had in the beginning of March. And I guess in your view, two-part question, do you think that is this sustainable? Like, how does this rally kind of smell to you, I guess would be the way to say it. And on the other side of that, what do you think is the driver of equities over the second half of the year? I mean, is it economic data, or is it really just going to be about how low, I guess, we keep coronavirus case counts as things start to reopen?
Well, look, this was a unique situation in that we went from all or nothing with regards to economic activity. And so we priced in a very disastrous economic outcome quickly. Could it have gotten worse? Yes, but policymakers responded in a meaningful way. And then from there, what this market has largely been trading on is modest improvements. Now, maybe improvements isn't even the right word, but things getting worse at a less significant rate. And so, markets don't typically trade on good or bad. There's nothing good about what we're going through right now, but they tend to trade on whether things are getting better or worse. And so, since the markets bottomed in March 23rd, you've seen cases plateau in the States. You've seen jobless claims peak and start to slow. And so the markets are reflecting these things. Again, it's not good. The levels aren't good, but the change in the rate of change is improving. And, as a result, the markets have responded in kind.
Hey, Brian, I have a question just about the rotation that we've seen recently, the shift to cyclicals and to value. I'm curious what your take is just about the timing of this and whether or not you're seeing any investment opportunity in some of those names now.
Yeah, I mean, look, it's actually been better breadth in the market rather than a full shift from value to growth or late cyclicals to early cyclicals. You actually have 95% of the S&P 500 companies trading above their 50-day moving average. So that's pretty good breadth that we've gotten to. Look, if there's a light switch that we're going to flip and all of a sudden we're going to reopen and we're going to start to re-engage and we're going to get a V-shaped recovery, then by all means, investors are going to want to buy early cyclicals, value-oriented parts of the market. I mean, whether it's hotels or airlines or energy or banks, these types of things that are going to do better with improvements in activity. If you're like me, you're probably thinking that it's going to be start of a stop, start, stall, fits and starts, put your toe in the water, slowly figuring out how we're going to ultimately do this, cases emerging in certain areas as we do this. And so I don't envision it as a V-shaped recovery. I envision it as a long drawn out recovery, which to me likely continues to favor those companies that can generate revenue growth in this type of an environment, a slow growth environment. And quite frankly, I think that persists far beyond this. I think that we emerge from this similar to how we emerged from '09, but even more so in that we're in a very slow growth world and policy remains accommodative for a very, very long time as we try to get back to full employment. And in that environment, I suspect the companies on the cutting edge of the structural growth changes in society will be the winners. Yeah, you'll have a brief bout of early cyclical value orient. That's what happens. But ultimately, I think the winners are going to be the true growth companies.
All right, Brian Levitt, Global Market Strategist at Invesco. Always great to get your thoughts. Thanks so much for joining us today. Have a great weekend.
Thank you.